Okay, guys, we just spoke about the continuation flags of patterns, bullish flags and bearish flags on part C of our part 3 of our strategy. Okay, so since all we spoke about, we've already know how to identify the trend. We already know how to make use of the higher time frame to the lower time frame, looking for continuation patterns, looking for which part of the phase are we in the market, looking for market direction. Right now, we're gonna be dealing with the continuation patterns in the market. So remember, the most important thing for you to be able to say the market is going in a certain direction or is going. Remember what we spoke about in the part 1, phase 1 strategy. Part 1 strategy, part 1. We spoke about that something if it's in a downtrend like this, something is in a down. The only time that we'll say now the market is going to be going up, it's when the market breaks above these strong points. Before the market breaks above this strong point, there is no confirmation that the market is going towards the way is going up. Even if the market it can give you a strong momentum push from this point, and then you see two strong candles pulling to this point, don't be looking for buys. This is not yet confirmed. There is no confirmation to say the market is going up until it breaks above here. Then now we have confirmed that the market is going to be going up. We're just going to be having to do what? We're just going to be having to look for what continuation patterns now to be jumping in again. That is the only ever confirmation you would ever have. Okay, I'm giving you this explanation because the last time we were live in the market, this part of the graph was not here. This part of the graph was not here. This part, I think this part of the market was not here. Okay, so there was a point whereby we had a structure which looks like this, and then I was live on TikTok, and then people said USDJPY is selling. I said, guys, there is no way and point whereby this market is confirmed that it's selling, because by looking at this structure, we've already shown you how to identify the structure. You can already see that it is a higher high, it's a higher low, it's a higher high, it's a higher low, this is the higher high. Until the market breaks below this point right here, we are not yet confirmed to say this thing is going down. But we can still say the market is still in an uptrend because the market has not yet broken up below this point. So we still have impulse correction, impulse correction, impulse correction, and currently the market is in a what? In an impulsive phase. That is the only thing that the market is in at. So what you need to do is for you to identify the continuation patterns in this thing. We've just spoke about this. We just need the continuation patterns within the new impulsive phase that is forming up. Okay, so that is what I was saying when I said that. So what you need to do, as you can see here, could have used this as your continuation patterns. This was going to be slightly a bit difficult because, as you can see, of the momentum that this thing is moving in. So the best way for you to could have used this into your advantage is to wait for the market to give you what? A strong push to the upside and start to give you what? A continuation patterns. Then that is when you could have been able to catch this thing, because you know that it is an impulsive phase. You want to be looking for what? For buying opportunities. Okay, it was a little bit difficult for us to have taken these buys. I couldn't myself take a buy which looks like this. I don't use things, I don't just enter a trade. Remember, I don't just enter a trade. Hence I said that I only use two things: bullish flag and bearish flag. Okay, but if the market really did give me a bullish flag here, I was not going to doubt to say the market is still gonna go up. Why? Because higher high, higher lows, the market is forming higher highs, higher lows, and the market was not yet broken below one of my higher lows. So therefore, why would I doubt my market giving me a continuation patterns to say we are going up? Because I know for sure that it is what is an impulsive phase of the market. Okay, so these are the things that I need you guys to be looking at. You need to look for a continuation pattern in the impulsive phase, need for those bullish flags. Okay, so that is what I was talking about. So if we can go to a 4 hour time frame in this case right now, because even this structure, as you can see, it gave you impulse correction, impulse kind of correction. Even right now at this point right here, the market gave you this strong push, this strong impulsive phase. So you can't really say the market is not kind of giving you a double top. It's gonna say yes, it can do that, but wait for the confirmation. At least the market should confirm, because if the market comes break below this point right here, therefore, which means it's gonna tell you that it has just confirmed that it's about to be taking the new correction, and then it's still gonna shoot up because we're still in an impulsive phase, and the market even broke above the previous high. As you can see here, this was the previous high. So the market can still give you a correction and still shoot towards the upside. Yours that you need to do is to wait for the right time so that you can be able to execute your trade. Okay, so those are the things that I want you guys to understand. Look at your structure. Like in this case, we just looked at our structure. We just look at the structure. Okay, what structure is this? This is an uptrend because it's giving higher highs, higher lows, higher highs, higher lows, higher high, higher lows. You see, and then we just identify the direction of the trend, and the next thing is to identify which phase of the market are we currently in. If we find that we are in an impulsive phase of an uptrend, therefore we're just going to be looking forward for continuation patterns so that the market moves in the direction we want to see it moving on. Okay, so as you can see on this cap JPY as well, so this is a cap JPY. So by looking at this structure right now, I don't want us to go that far with this structure, but by looking at this, let's just start from this lowest point right here. As you can see, the market from this lowest point right here, the market gave you as impulsive correction, and then this new move to the impulsive side, you can see that it broke above this point. This is our last high, and you can see that the market broke above that point right there. Does it mean that now, because on a daily time frame we are seeing this strong selling candle, does it mean that we're going to be going down? At the moment, it doesn't really mean that until the market breaks up below this point right here. You see, until the market breaks below this point right here. But we can make use of, because you can see that this was the impulsive phase. When you go to more lower time frames, you could see that the market is going to give some sort of like a correction in this point. It's still going to give you some sort of like a correction in this point before it goes all the way to shoot up. So the more you go to even lower time frames, you would see a certain structure that you can make use of. Let's just go and see. But you mustn't forget that you are in a correction phase. So if the market gives you a sign that now it's going up, you need to be jumping in to be saying, "What, we are going in." Yeah. So maybe the market, like in this case, giving you an impulsive phase, if it can give you some sort of like a correction, you can make use of it, because the market is still within the correction, and the correction is going to be what is going to be selling maybe until to a point whereby, because the market usually retraces 50 to 61.8% of the golden zone, until maybe the market reaches this golden zone right here of Fibonacci. Okay, we're still going to be talking about Fibonacci, guys. I'm still going to show you another move on how to use Fibonacci. Okay, so which is this continuation pattern, so you can still make use of these selling opportunities. All I want you guys to understand is that once you understand that the market is currently in a correction phase of an uptrend, know that you can just make use of those continuation patterns. You don't just say sell because you feel like the market is going down. No, you don't do that. You wait for the confirmation to say, let me see the continuation pattern. Maybe the market is still having that momentum to say it's going my direction. Then you can make use of this direction. I hope you guys do understand what I'm trying to say to you, because it's just simple and straightforward, guys. It's just simple and straightforward. Okay, so let's just talk about Fibonacci retracement quickly. Let's just talk about Fibonacci retracement quickly. So the Fibonacci, according to it, is that when the market gives you an impulsive move like this, when it corrects, the correction phase, usually the correction phase of the market, it moves 50 to 61.8% before it shoots to the other direction. This thing, it's like a spring, guys. If you can think of Fibonacci more like a spring, if you take a spring, let's say this is the normal spring that is not compressed, okay? This is just the normal spring which is not compressed. It looks like this, okay? This is the spring that we have which is not compressed. So let's just say 10%, let's just say 20, 40, 20, 40, 60, 800 until 100. Let's just say it's like that. 20, 40, 60, 80, 100. Okay, yeah, let's just put it that way. If you compress this spring, if you compress this spring up to this size, if you compress this spring up to this size, if you compress this spring up to this size, compress it up to this size, and someone else compresses, let's say you compress this spring to 30% right here, and then someone else compresses this spring to something like 40%. Let's say someone else compresses, this is a reference point, this is our reference point right here, and then someone else compresses this spring to like 40%, and then someone else compresses this spring to 61.8%, something like that. Someone else compresses the spring to that point of 50, between 50 and 61.8%. If this is the original size of the spring, and then this was compressed, let's say 30, this one 40, this one 50 to 61 point something percent. When you let go of the spring, if you were holding it using your finger, your thumb, and your whichever finger, and then when you let go, the bounce of this spring and the bounce of this spring and the bounce of this string is not going to be the same. The one that has been compressed more, when you let go of it, it's gonna spring, is gonna like jump to a distance which is way above the both of these two. Okay, so if the market really did give you, let's say the market gave an impulse and it retraced like this, chances that when the market is, let's just make this to a practical example. If this spring is compressed 30% and then this is your 30% right here, and then chance when the market goes to the other direction, it's not going to move that much. It's going to move like the size of which it was compressed. It's not going to be that impactful. But when the market is compressed a little bit like this one, giving us impulse, and then it's compressed a little bit bigger, it's going to move a bit bigger distance than this one that was compressed 30%, this one whereas it's compressed 40%. But when the market is being compressed 50 to 61.8%, which is somewhere here, therefore the market is also going to move the same distance like that. See, this is the best example I can give about Fibonacci retracement. If it did get you to 50 to 61.8%, the impact that it's going to have once it reaches that point is going to be a little bit bigger. It's going to be bigger when you take a Fibonacci from this point. This is your original spring size. When it's compressed to 60.1, it's going to shoot all the way up. But when it's compressed lesser and compressed lesser, the impact is not going to be that bigger. So hence we want to see the market retracing to our golden zone, so that the market going to move in a very highly position, which is this. So your Fibonacci looks like this. If you go to your settings of Fibonacci retracement, um, you can come and remove all these other percentages. Like if you come click here on, if you're using TradingView, you can just double click on Fibonacci. You remove all these other percentage. You just want 50% and 61.8%, of which this is what I have. Of which this is what I have. When I do this, when I take my chart, giving me impulsive correction, impulsive, I know that when I come to my chart, I'm going to take where the impulsive started to where it ended. So I know that my golden zone is going to be between 50 to 61.8%. So of which means I'm expecting to see what the market to retrace from this golden zone, and then it shoots all the way to the upside. You see, so what we want to see is that when the market gives you, if you are in a higher time frame like this is your higher time frame, you see something like this, and then this is what you see right here. And then now you want to be using this as your advantage, taking selling opportunities all the way to 61.8% zone. Let's say you take your Fibonacci, you know that the market is in an uptrend, and then currently now the market is kind of in a correction phase. Now you want to be like, okay, am I'm gonna be taking these selling opportunities up to which level, because you do not know where's the market going to turn, you know? So you can make use of the what, of the Fibonacci, and be able to say that, okay, my market can go all the way down until the what, the golden zone, because that's what most of the time it does. It do that, it moves all the way until the golden zone. Therefore, you know that if you see a continuation pattern somewhere here, you can be what, you can make use of it to say your take profit is going to be somewhere closer to the what, to the golden zone, of which you are not wrong. You do just understand the market structure. So that is how you use your Fibonacci retracement. You get your, you want your market to compress the spring like 50 to 61.8%, because you know after that the market is going to give you a strong push to the other side. Okay, so that is how I use Fibonacci retracement zones. Okay, so in this case right now, if I were to use the Fibonacci retracement zone, I can say I'm expecting to see the market to do what, maybe come retrace all the way until to this point right here. But does it mean that I can take a sell right now and be like, okay, sell from this point to say what, to this point? No, I can't just sell while the market is in an impulsive. This is an impulsive. So I want the market to do what? To at least be in the exhaustion, like to give me some sort of like, okay, I'm collecting power now, so that I can shoot again all the way towards the downside. Because if you say sell, you're gonna place your stop loss somewhere here. So these things gonna come take your stop loss out, and then it goes your direction, and then it'll be like, okay, these people, they are checking me when I'm entering the market and all of that. See, and this thing is gonna shoot your direction, something like that. You get what I'm saying? So this is how you use Fibonacci retracement, and then this is how you use your what, your continuation pattern retracement. So your continuation patterns, or your bullish flag or your bearish flag, you want them to retrace up to 50 to 61.8%, so that they can be that efficient to shoot in the direction of your market. Okay, so those are the things that you need to understand. Those are the things that you need to do. Okay, so we spoke about bullish flags, bearish flags. We spoke about how to use the Fibonacci to take advantage of this. So next time I'm going to be talking about support and resistance, in terms of trying to figure out, like, if let's say, okay, we're gonna talk about that one. Third touches of trend lines, support and resistance, whereas using the market structure. Okay, we need to also use that to make use of our strategy using support and resistance or trend line and all of that. Okay, so this is gonna be part 3A. We are done.